we want to explain depreciation here, okay? So depreciation is the best tax write-off on the planet. As you know, when you buy a property, by the way, is Diane Kennedy here in the room? Oh, you're here? Awesome. Okay. So correct me where I'm wrong here. We've got our CPA in the room. So when you buy a property, you've got to divide it into the two component parts, of course, value and improvement value. So you've got the land here, right? Land. And then you've got a house sitting on the land. And the IRS says that basically when, when some item that you use in your business becomes of no further economic value, you can take a write-off on it, right? So, eventually this computer that I bought for my business will be of no value. It'll be obsolete. It will just eventually blow up and die. Of course, it's an Apple, so it will last way longer than all those stupid PCs you guys use. But that's a whole other story. So someday, the house will be of no further economic value, right? It will eventually just fall to the ground, disintegrate. Something, termites will get it, whatever, right? And so the house will be of no value. So the IRS decided in its wisdom, instead of taking a deduction when the house just falls to the ground, we will let you depreciate the house over 27.5 years and take 1/27th, essentially, of that per year. 127.5 is the exact number. And so if the land value, let's just kind of divide this equation up. If the land value in this example is $20,000, and the improvement value, the house sitting on the land, is $80,000, then the total value is $100,000, right? So we bought a $100,000 property, right? So we got that. Now, pull out your smartphones and just help me with the math here and take 80,000 and divide it by 27.5. He's reading it because typing the calculator is too hard. Yes. I dictate to my iPhone all the time, and it is scary bad how you could totally have a major miscommunication doing that. Yeah, but I still do it because I can't type. How much? So it's not exactly. How much exactly? 2909. 2909. So the IRS basically says if you qualify to take depreciation tax deductions, and I'm not a tax advisor, Diane is, so she'll be up soon, and she can tell you more. But if you qualify, you get to write off $2,909 every single year for 27.5 years. And at the same time that you're taking that write-off every year, the house could go up in value 10% every year. You could have positive cash flow on the house, but you still get this deduction because the IRS doesn't count correctly. And this is why it's really good and bad the way our tax code is, because the IRS doesn't accurately account for inflation. And that hurts most people in a lot of different ways and different scenarios. And Dan Ammerman, who's been on the show many times, I know Kathy's been to a seminar, I think a few others have as well. And, that hurts most people. For us as real estate investors, if we qualify for this deduction, it is the holy grail of write-offs. Because think about it, if you want to get a write-off in any area of your life, one is that you either spend money on your business, buy some more advertising, hire some new people, buy some new equipment if you own a business, right? Then you can deduct that. Or you could donate money to charity. You could take a deduction on that. But here, you didn't have to write a check. When you saw my tax return earlier this morning, and it showed $524,742 of tax deduction, that was on the portfolio I had at the time of, around 20 properties, something like that. And those properties could have all been going up in value, all have positive cash flow, and I still get this write-off. It's like a phantom write-off. It's the holy grail of tax benefits, making income property the most tax-favored asset in America. So qualifying for this tremendous write-off. So the IRS, of course, penalizes you because what it says is if you make over $100,000 per year, we're going to start phasing this opportunity out, okay? And when you go up to $150,000, it's gone completely. So one of the ways around this that you may or may not be able to do, it's not easy, by the way, is that you can potentially qualify as a real estate professional. And that doesn't mean you get into the business of selling real estate or anything like that. It just means that you're a professional investor, basically. And to qualify for that is a long and complicated conversation. And I've done several podcasts on it. I haven't done one lately, so maybe Diane will want to come back on and we'll do a whole hour on this. It's a complicated topic. But essentially, yes. No, it's harder than that. Okay? So a couple of the criteria, okay, and Diane can speak to this more, you can ask her. A couple of the criteria are you must have at least 750 hours per year dedicated to the profession of being a real estate investor, 15 hours a week, but 500 of those hours must be material participation or active participation. So get this. Now, of all the people you know, don't you think that yours truly is someone who kind of like eats, lives, and breathes real estate? Right? You would think that of me, right? I hope. I got audited for this. Yeah, I actually got audited. I couldn't believe it. And they kind of were targeting real estate professional people. And so they audited me for 2007. The audit took 3 years. It started in 2010, I guess it was. Started in 2010. And the auditor used to come to our office every day. His name was Jack. Sarah met Jack. Remember Jack, Sarah? Yep. Yeah, he what? Yeah, I think that's probably illegal, but I did go to Starbucks with him a few times. Yeah. And so they audited me. I found a whole bunch of other deductions. I won the audit, and the IRS paid me over $400,000. So I just have a feeling they're not going to be back to visit me again. Okay. Now, admittedly, it was a hassle. Okay, it was a real hassle, and it cost me about $20,000, $30,000 in accounting fees. Okay, so but it did turn out great. I'm so glad they audited me. It was like having a free bookkeeper, and they found all these new deductions, and I realized I needed a better accountant. But it was what's that? A very good cash on cash return. It was phenomenal. So that's the basic crux of it, but then there are other qualifiers of how much of your income comes from your real estate versus your job, your day job, and it gets pretty complicated. So Diane can't speak to that. But here's what they audited me on, though. This is the specific part. It's this part, the 500 hours. They believed me that I spent over 750 hours a year in real estate investing, okay? But they didn't believe the 500 hours, and the reason they didn't believe is because at the time I had property managers for all of my portfolio. And they said, if you have a property manager, we don't believe that you are actively participating. Now, you can speak to this, okay, but some accountants say, put it into your property management agreement that you will, approve all tenants. And some managers and some investors, they work differently. Some want to be really involved and engaged in the whole process. Some are like, just keep the thing running and don't ask me any questions. That's not going to work for the IRS, okay? So there are multiple layers to this onion, of course, and that's just a couple of them.